You have heard the whispers. They echo through social media feeds, pop up in group chats, and are shouted from financial news headlines. Buy this stock now. Crypto is the only future. Don't miss the next big thing. These urgent calls are exciting. They promise quick riches and the thrill of insider secrets. This is the noise of modern finance, a relentless barrage of tips, predictions, and bold proclamations. It's designed to grab your attention, play on your fear of missing out, and make you feel immediate action is the only path to success. This constant financial chatter creates a powerful illusion. It suggests wealth is built through brilliant high-stakes moves. It paints successful investors as daring visionaries who predict market turns with uncanny accuracy. Gut feelings are celebrated, bold bets are glorified. The narrative is compelling, like a Hollywood blockbuster where heroes go all in and win big. But this narrative, entertaining as it is, has little to do with how sustainable wealth is actually created. It's sold by those who profit from activity, not your long-term prosperity. For young professionals starting their financial journey, the distinction between loud noise and quiet signal is more critical than ever. In early career stages, every financial decision carries significant weight. The habits you form now, the philosophies you adopt, the sources you trust, will compound over decades. Falling for the hype leads to costly mistakes, chasing fleeting trends that evaporate quickly. It turns investing into stressful, gambling-like activity, eroding your capital and your confidence. The alternative to this chaos is a calmer, deliberate approach, one that filters out noise and focuses on signal. This method doesn't rely on gut feelings, hot tips, or viral trends. Instead, it's anchored in something more reliable, evidence. It asks a profound question. What does decades of data actually tell us works? This is evidence-based finance, a rational framework that replaces speculation with science and emotions with proven principles. The appeal of dramatic, story-driven investing is deeply human. We are wired to respond to narratives, especially those of triumph against the odds. We want to believe that we can be the one to find the next Amazon in a garage or to time the market perfectly, selling at the peak and buying at the bottom. These stories are far more engaging than the quiet, almost boring reality of successful investing. The drama is captivating. A simple bar chart showing steady, long-term growth is not. Financial media understands this perfectly, which is why it amplifies the drama. A story about a meme stock creating an overnight millionaire will always get more clicks than an article about the benefits of low-cost index funds. However, when we step back from the frantic energy of the moment and look at the hard numbers, a different picture emerges. The data consistently shows that the very strategies that create the most excitement are often the least effective over the long run. The evidence reveals that trying to outsmart the market is a losing game for the vast majority of people, including most professionals who are paid handsomely to try. The data shows that high fees, frequent trading, and emotional decisions are the primary destroyers of wealth. It proves that the boring strategies, diversification, low-cost investing, and patience, are the most reliable engines for building real, lasting financial security. This is precisely why a data-driven approach matters so much, especially for those who are not looking to treat their life savings like a lottery ticket. Your financial future is too important to be left to chance, hype, or unverified claims. Building wealth is not an art form based on intuition. It is much closer to a science, guided by principles that have been tested, studied, and validated over time. Just as a doctor would rely on clinical evidence to prescribe a treatment rather than on a popular health fad, an evidence-based investor relies on academic research and historical data to build a portfolio. This mindset shift is the single most powerful tool you can have. Therefore, this essay will serve as your guide to making that crucial shift. We will move beyond the headlines and dive into the evidence. We will explore the psychological traps that cause so many to make poor financial choices, and contrast them with the logical principles that underpin long-term success. The goal is not to give you hot stock tips or to predict the next market crash. Instead, it is to provide you with a durable framework for thinking about money. A framework that empowers you to tune out the noise, focus on what you can control, and make smarter, more confident decisions that will serve you well for the rest of your life. At its core, evidence-based finance is a philosophy that proposes a simple, yet revolutionary idea: your financial decisions should be guided by the best available scientific and historical evidence, not by intuition, emotion, or popular opinion. It treats investing and financial planning less like a speculative art form and more like a field of science, similar to evidence-based medicine. A doctor doesn't prescribe a treatment because it feels right or is trending on social media. They recommend it because rigorous, peer-reviewed studies have proven its effectiveness and safety. Evidence-based finance applies this same disciplined, rational logic to your money, demanding proof over prognostication and data over drama. This approach requires a fundamental shift in mindset. Instead of asking, what is the next hot stock, or what is the market going to do next week, the evidence-based investor asks different, more powerful questions. They ask, what does decades of market history tell us about the sources of long-term returns? Or what does academic research say about the most reliable way to manage risk? Or what behavioral biases are most likely to cause me to make a costly error? The focus moves away from the impossible task of predicting the future and toward the achievable goal of building a robust strategy based on time-tested principles that have been shown to work across different market cycles. This doesn't mean finance becomes entirely predictable or devoid of risk. The future will always be uncertain, and markets will always have their ups and downs. However, an evidence-based framework provides a sturdy anchor in the face of this uncertainty. It acknowledges that, while we cannot control market outcomes, we can control our own behavior, our costs, our asset allocation, and our long-term plan. By focusing on these controllable factors, which the evidence shows are the primary determinants of an investor's success, you systematically stack the odds in your favor. It's about replacing the anxiety of guesswork with the confidence that comes from a well-researched, logical process. Ultimately, adopting this philosophy is an act of intellectual humility. It is the recognition that the collective wisdom of decades of research is likely to be a better guide than one's own hunches or the confident predictions of a market guru. It means accepting that you, like virtually everyone else, cannot consistently outsmart the collective intelligence of millions of global market participants. Rather than fighting this reality in a costly and stressful battle, you choose to align your strategy with it. This disciplined approach builds a foundation for wealth that is not dependent on luck, but on a clear-eyed understanding of how markets actually function over the long term. Evidence-based finance stands firmly on three foundational pillars that work together to create a comprehensive and resilient framework for decision-making. The first pillar is academic finance. This includes the groundbreaking, often Nobel Prize-winning research that has shaped our modern understanding of risk and return. Think of concepts like modern portfolio theory, developed by Harry Markowitz, which mathematically demonstrated how diversification can reduce risk without sacrificing expected returns, or the efficient market hypothesis, which posits that asset prices fully reflect all available information, making it nearly impossible to consistently beat the market. These academic theories provide the essential blueprint for constructing a logical and efficient portfolio. The second pillar is behavioral economics, a field that blends psychology with economics to understand why people make irrational financial decisions. Researchers like Daniel Kahneman and Amos Tversky have identified dozens of cognitive biases that sabotage our financial well-being. These include loss aversion, the tendency for the pain of a loss to be twice as powerful as the pleasure of an equal gain, leading to panic selling. It also includes overconfidence bias, which causes us to overestimate our own predictive abilities, often leading to excessive trading and concentrated risky bets. By understanding these built-in mental glitches, an evidence-based investor can create systems and rules to protect themselves from their own worst emotional impulses. The third, and arguably most crucial pillar, is empirical data. This involves the relentless analysis of long-term historical market performance. Organizations like Standard & Poor's, through its SPIVA reports, and Morningstar meticulously track the performance of investment products over many years. This data provides the real-world proof that validates the academic theories. For instance, the data consistently and overwhelmingly shows that a vast majority of professional, actively managed funds fail to outperform their passive index benchmarks over any meaningful period. This hard evidence is what transforms the theory of low-cost passive investing from a mere academic concept into a practical and powerful real-world strategy for individual investors. These three pillars are not independent, they are deeply intertwined and mutually reinforcing, creating a robust system of checks and balances for your financial strategy. Academic research provides the why a strategy should work in theory. Behavioral economics explains why we so often fail to follow that strategy in practice. and historical data provides the what, showing the tangible results of different approaches over time. Together, they form a powerful trinity that allows you to build a financial plan that is not just theoretically sound, but also behaviorally resilient and empirically validated, giving you the highest probability of achieving your long-term goals. You know, the principles of evidence-based finance aren't just some abstract ideas stuck in university libraries. They've got a real history of being put into action, creating actual value for millions of investors. One of the biggest historical examples is the creation of the very first index fund by John C. Bogle back in 1976. Bogle, who founded Vanguard, was hugely influenced by academic research that basically said trying to beat the market was, well, a fool's errand. So he took that evidence and did something pretty radical for the time. He created a fund that didn't try to pick winners. Instead, it just bought and held all the stocks in the S&P 500 index, giving investors broad diversification at a super low cost. At first, Wall Street totally mocked Bogle's idea, calling it Bogle's folly, and even saying it was un-American because it was passive and not competitive at all. The financial industry, which made a ton of money from high fees on active management, really wanted to keep the myth of the star stock picker alive. But, the evidence just kept piling up. Over the next few decades, as more and more data came in, it became impossible to ignore the fact that Bogle's simple, low-cost index fund was consistently beating most of its pricier, actively managed competitors. This real-world example of evidence-based principles has saved investors billions, maybe even trillions, of dollars in fees, and made investing way more accessible for everyone. Another big shift was the rise of the fiduciary financial advisor. For a long time, a lot of financial professionals just had to make suitable recommendations, which meant they could suggest products that were okay, but not necessarily the best or cheapest. Often because those products paid them a higher commission. The evidence-based movement pushed for a much stricter fiduciary standard, which actually requires advisors to act in their clients' best financial interest all the time. This change, driven by data showing how conflicts of interest can really hurt investor returns, means that advice is now more likely to be based on what actually works, not just what pays the advisor the most. And today, the legacy of this movement is more accessible than ever thanks to modern financial technology. Robo-advisors are a perfect example. They're basically the digital version of evidence-based finance. They use algorithms to build globally diversified, low-cost portfolios based on your risk tolerance and goals, and they automatically rebalance your investments over time. These platforms are a direct translation of Nobel Prize-winning academic theory into something practical and affordable for everyday investors. So when you look at both the history and the present, it's clear evidence-based finance isn't just about playing defense. It's a proactive, powerful, and proven way to build and protect wealth in the real world. So if evidence-based finance makes so much sense, you might wonder, why doesn't everyone just follow it? Honestly, the answer isn't in spreadsheets or market data, it's buried deep in the wiring of our own minds. The biggest threat to your long-term financial success isn't a stock market crash or a recession. It's actually the collection of predictable, irrational, and very human emotional biases that shape our behavior. See, these mental shortcuts, what psychologists call heuristics, evolved over thousands of years to help our ancestors survive immediate physical threats. They were great for deciding whether to fight or run from a predator, but man, they're just awful for making abstract, long-term decisions that modern investing requires. Our brains aren't naturally built to make us good investors. They're wired for survival in the here and now. And that creates a pretty big conflict between what our instincts want and what sound investing demands. The market rewards patience, discipline, and a long-term perspective. But our brains? They crave instant gratification, get hijacked by fear and greed, and are always looking for patterns, even when there aren't any. This mismatch is the main reason so many investors end up buying high when they're excited and selling low when they panic, basically destroying their own wealth over time. The first step to beating this enemy is just admitting it exists in all of us. It doesn't matter how smart you are. In fact, sometimes the smartest people are the worst investors because they think they can outsmart their own biases. But these emotional reactions aren't something you can just reason your way out of. They're powerful, automatic, and they're universal. Understanding them is kind of like a sailor learning about ocean currents. You can't stop the current, but if you know how it works, you can steer your ship to avoid the worst of it. In finance, that means setting up systems, rules, and automated processes that act as a barrier between your emotions and your investment decisions. So, before we can really use the logical strategies of evidence-based finance, we have to become students of our own psychology. We need to figure out which cognitive traps are most likely to mess up our plans. By shining a light on these hidden forces, we can spot them when they show up and build a framework that protects our portfolios from our own worst instincts. This kind of self-awareness isn't just a nice bonus to an investment strategy, it's the absolute non-negotiable foundation for lasting financial success. Without it, even the smartest plan is pretty much doomed to fail. Now, let's talk about two of the most powerful and honestly most destructive emotional biases: loss aversion and overconfidence. These are like two sides of the same psychological coin, and they can totally wreck a portfolio, whether the market's going up or down. Loss aversion is a concept that psychologists Daniel Kahneman and Amos Tversky really brought to light. It describes this simple but super important human quirk. The pain of losing money is about twice as strong as the pleasure of gaining the same amount. So losing $1,000 just feels way more painful than gaining $1,000 feels good. This psychological imbalance has huge consequences for how we behave as investors. It basically turns rational decision-making upside down. This intense fear of loss often leads to one of the most common investing mistakes: panic selling. When the markets drop, as they always do from time to time, the pain becomes so overwhelming that the instinct to make it stop takes over. Investors sell their holdings at exactly the wrong moment, locking in their losses. They might tell themselves they'll get back in when things calm down, but honestly they rarely do until the market has already bounced back a lot. This single behavior, selling low because of fear, is a major reason why the average investor's returns are almost always lower than the market's actual returns. People end up paying a steep price just to ease their emotional discomfort. On the flip side, there's overconfidence bias. That's the tendency to believe we're smarter and more skilled than we really are. In the markets, this bias gets even stronger during bull runs, when everything seems to be going up. When our stocks are rising, it's easy to think we're geniuses, instead of just lucky to be riding a rising tide. This inflated sense of skill leads to some pretty risky behaviors. We might start trading more often, thinking we can time the market, or we might ditch diversification and put all our money into a few sure-thing bets, convinced we've got some special insight. Overconfidence is a dangerous trap. It pushes us to take on way more risk than we can actually handle, and we usually don't even notice it. All that extra trading racks up transaction costs and taxes, and putting too much money into just a few investments leaves us really exposed when the market turns. The combination is pretty lethal. Overconfidence builds a shaky portfolio during the good times, and loss aversion tears it down during the bad. Recognizing this destructive cycle is the first step to breaking it and to building a more resilient, behavior-proof financial strategy that can actually go the distance. Our brains have a very short memory. We tend to give undue importance to recent events, a cognitive shortcut known as recency bias. This makes us believe that whatever has been happening lately will continue to happen indefinitely into the future. When the stock market has been on a tear, we start to believe that strong returns are the new normal. We forget the lessons of past downturns. The phrase, "this time it's different," becomes our mantra. This bias is why investors pile into assets at the peak of a bubble, whether it was dot-com stocks in 1999 or certain speculative assets in more recent years. This belief in recent trends makes us vulnerable to another powerful psychological force: herd mentality. As humans, we are social creatures with a deep-seated instinct to follow the crowd. It feels safe and validating to do what everyone else is doing. When recency bias convinces us that a particular asset class always goes up, and we see our friends and colleagues making money from it, the fear of missing out, FOMO, becomes almost unbearable. The combined pressure to conform and the desire to participate in easy gains can overwhelm our rational judgment, compelling us to join the stampede, often just as it is heading over a cliff. The problem is that the herd is almost always wrong at major market turning points. The crowd is most euphoric at the market's peak and most despondent at its bottom. By following the herd, you are almost guaranteed to buy high and sell low. An evidence-based investor must cultivate the discipline to do the opposite, to be skeptical when everyone else is greedy, and to be cautiously optimistic when everyone else is fearful. This requires a strong conviction in your long-term strategy, and the emotional fortitude to stand apart from the crowd. It means trusting the data more than you trust the prevailing mood of the moment. Ultimately, recency bias and herd mentality are traps that chain your financial future to the whims of market sentiment. They prevent you from executing a consistent, long-term plan. Evidence-based finance provides the antidote. By anchoring your decisions in decades of historical data rather than the last few months of market performance, you can break free from this short-term thinking. Acknowledging that market cycles are normal and that today's hot trend is often tomorrow's cautionary tale allows you to tune out the noise, ignore the herd, and stay focused on the disciplined actions that truly build lasting wealth over time. After exploring the psychological traps, it is time to turn to the cold, hard numbers. Let's set aside the stories, the predictions, and the emotional drama. Let's look at the evidence of what actually works. The financial industry is built on a compelling promise that skilled professionals can beat the market. They command high fees for this supposed talent. Millions of investors trust them, believing they are paying for superior performance. But the data tells a starkly different story. It is a story of widespread, consistent, and profound failure. Year after year, Standard & Poor's releases its SPIVA scorecard. This is not an opinion piece. It is a meticulous, data-driven report that compares actively managed funds against market benchmarks. The results are not just bad, they are devastating. Over any meaningful long-term period, the vast majority of active fund managers fail to outperform the simple market index. For example, over a 10-year period, over 90% of U.S. large-cap fund managers have underperformed the S&P 500. This is not a recent phenomenon. It is a consistent pattern across different decades, different countries, and different asset classes. Whether you look at large companies, small companies, or international stocks, the conclusion is the same. The small handful of managers who do outperform rarely continue to do so. Yesterday's star performer is often tomorrow's laggard. The search for a manager who can consistently beat the market is like searching for a unicorn. They are exceedingly rare, and identifying one in advance is practically impossible. The implications are profound. The very foundation of the traditional investment industry is built on a premise not supported by evidence. Investors are paying higher fees for worse results than a simple, low-cost alternative. They are playing a game heavily stacked against them. The data doesn't suggest active managers are unintelligent. It simply confirms that beating the market is incredibly difficult to do consistently over time. If trying to beat the market is a losing proposition, what is the alternative? The evidence points to a simple, elegant solution. Instead of trying to beat the market, you should simply aim to own it. This is the core principle behind passive investing, most commonly executed through index funds or exchange-traded funds, ETFs. An index fund does not employ a team of highly paid analysts. It does not make bets on which sectors will boom or bust. It simply follows clear rules to buy and hold all securities in a specific market index such as the S&P 500 or a total world stock market index. The logic is compelling. By owning an index fund, you capture the full return of the market. It tracks minus a tiny fee. You're not finding the needle, you're buying the entire haystack. This transforms investing from a zero-sum game of winners and losers into a positive-sum game. When you invest in active funds for you to win, another must lose, but when you own the whole market, you participate in collective growth of the economy. You harness the power of capitalism, betting on human ingenuity and progress rather than stock-picking skill of a single manager. This strategy isn't just theory, it's championed by successful figures in finance. Warren Buffett, arguably the greatest investor of all time, has repeatedly advised that most people should invest in a low-cost S&P index fund. He understands that for most people the attempt to be clever is the enemy of good results. Data from research firms like Morningstar confirms this wisdom, showing funds with lower fees have higher probability of success simply because they have lower hurdles. Therefore, the evidence is clear. The most reliable way to build wealth is not searching for star managers, but embracing broad diversification through passive index funds. It's less exciting. It won't give you bragging rights of picking stocks that triple, but it provides the highest probability of achieving your financial goals. It's built not on hope or hype, but on decades of real-world data. It's choosing to stop playing a game you're unlikely to win and instead own the entire field. One of the most critical, yet often overlooked pieces of evidence in finance relates to the corrosive power of fees. Investment costs may seem small, a 1% or 2% annual management fee can sound trivial. However, the data shows these seemingly small percentages have a devastating impact on your long-term wealth. due to the unforgiving math of compounding. That 1% fee is not just 1% of your initial investment, it is 1% of your total assets, year after year after year. Over an investing lifetime of 30 or 40 years, this silent drain can consume a staggering portion of your potential returns, often without you even noticing. Let's consider a simple, evidence-based example. Imagine two investors who both start with $10,000 and earn a 7% average annual return over 30 years. Investor A invests in a low-cost index fund with an annual fee of 0.1%. Investor B chooses an actively managed fund with a fee of 1.5%. After 30 years, Investor A would have approximately $72,500. Investor B would have only about $49,500. The 1.4% difference in fees has cost Investor B over $23,000, or roughly a third of their potential wealth. This is the tyranny of compounding costs. The evidence is clear: costs are one of the most reliable predictors of future investment returns. It's about which funds are least likely to perform worst. A high-cost fund starts each year with a significant handicap. It must exceed the market's return to cover its own fees just to break even with a cheap index fund. This is a feat that very few managers can accomplish consistently. By choosing low-cost investments, you are directly improving your odds of success. This is one of the few variables you have complete control over. You cannot control the stock market. You cannot control the global economy or interest rates. But you can absolutely control how much you pay for your investments. The data implores us to be relentless in minimizing costs. Choosing a low-fee index fund over a high-fee active fund is one of the most impactful financial decisions you can make. It ensures more of your money's growth stays in your pocket, compounding for your benefit, not for the benefit of a fund company. The final, crucial piece of evidence we must examine addresses one of the most tempting and destructive behaviors in investing: market timing. This is the attempt to sell your investments just before the market goes down and buy them back just before it goes up. In theory, it sounds like a brilliant way to enhance returns and avoid losses. The data, however, delivers a brutal verdict. Successful market timing is a myth. It is practically impossible to do consistently, and the attempt to do so is far more likely to harm your returns than to help them. The evidence shows that your wealth is built not by moments of brilliant timing, but by the slow, steady accumulation of time spent in the market. Research from numerous sources, including Fidelity and Dalbar, has quantified the immense cost of trying to time the market. A large portion of the stock market's long-term gains comes from just a handful of its best trading days. If you are out of the market on those key days, your returns can be crippled. For instance, an analysis might show that over a 20-year period, if an investor missed just the 10 best days in the market, their total return could be cut in half. If they missed the 30 or 40 best days, their return could be wiped out entirely. The problem is that these best days are impossible to predict. They often occur during periods of high volatility, right after the worst days. This data proves that the real key to harnessing the market's power is not to dance in and out of it, but to remain invested through its inevitable ups and downs. This is the principle of time in the market, not timing the market. It requires discipline and a long-term perspective. It means accepting that downturns are a normal and unavoidable part of the investing journey. Instead of viewing a market drop as a catastrophe to be avoided, an evidence-based investor sees it as the price of admission for capturing the superior long-term returns that equities provide. The pain of the downturn is the fee you pay for the eventual recovery and growth. Therefore, the most effective strategy, supported by overwhelming evidence, is to create a sensible, diversified investment plan and stick with it. This means continuing to invest systematically through good times and bad, a practice known as dollar-cost averaging. This disciplined approach removes emotion from the equation and prevents you from making the catastrophic mistake of selling at the bottom. The data is unequivocal. The investors who achieve the best long-term results are not the ones who trade the most or have the most complex strategies. They are the ones who stay the course, tune out the noise, and let the powerful force of time and compounding do its work. Now that we have dismantled the myths and examined the hard data, we can build a positive framework for action. The evidence does not just tell us what to avoid, it provides a clear blueprint for what to do. The first and most fundamental principle of this blueprint is diversification. This is the simple, age-old wisdom of not putting all your eggs in one basket. The data overwhelmingly supports that concentrating your investments in a single stock, a single industry, or even a single country is a form of uncompensated risk. You are taking on the potential for catastrophic loss without any reliable expectation of higher returns. Diversification is the most effective tool we have to manage that risk. A properly diversified portfolio spreads your investments across thousands of companies, multiple industries, and numerous countries around the globe. This means the failure of any single company or the downturn of any single economy will not devastate your entire portfolio. When one part of your portfolio is struggling, another part may be thriving, smoothing out your overall returns and reducing volatility. It is the financial equivalent of building a ship with multiple watertight compartments. A breach in one area does not sink the entire vessel. This principle, mathematically proven by Harry Markowitz in his Nobel Prize-winning Modern Portfolio Theory, is the bedrock of intelligent investing. Hand in hand with diversification is the principle of asset allocation. This refers to how you divide your portfolio among different types of investments, primarily stocks or equities and bonds. The data shows that this decision, the mix between your growth engine, which is stocks, and your stability engine, which is bonds, is the single most important determinant of your portfolio's long-term returns and risk level. It matters far more than any individual stock you might pick. Stocks offer higher potential for long-term growth, but come with greater volatility. Bonds, on the other hand, provide more stability and income, but with lower expected returns. Your personal asset allocation is your customized investment recipe. The right mix depends entirely on your personal circumstances, specifically your time horizon and your tolerance for risk. A young professional with decades until retirement can afford to take on more risk and would thus have a higher allocation to stocks, perhaps 80 or 90%. They have ample time to recover from any market downturns. Conversely, someone nearing retirement would have a more conservative allocation, with a greater percentage in bonds to preserve capital and generate income. Evidence-based investing demands that you consciously choose this mix based on your goals, not on a whim or a market forecast, creating a personalized strategy that is built to last. If diversification and allocation form the blueprint of your portfolio, then minimizing costs is the principle that ensures the structure is built efficiently and, well, without leaks. As we saw in the data, fees are a silent but powerful enemy of long-term wealth. The evidence is not just suggestive, it is conclusive. The lower the fees you pay, the higher your net returns will be. This is a mathematical certainty. Therefore, an evidence-based investor must adopt a mindset of relentless cost consciousness. They must scrutinize every fee, every expense ratio, and every transaction charge, understanding that every dollar paid in costs is a dollar that is not compounding for their future. This principle naturally leads investors toward low-cost investment vehicles, primarily index funds and exchange-traded funds, or ETFs. These passive instruments do not need to pay for expensive teams of star managers, analysts, or traders. Their goal is not to beat the market, but to replicate it as cheaply and efficiently as possible. As a result, their annual expense ratios are often just a fraction of what actively managed funds charge. Choosing a global stock index fund with a fee of 0.2% over an active fund charging 1.8% gives you an immediate and permanent 1.6% head start on your returns year after year. Honestly, this is the closest thing to a free lunch in all of finance. The war on costs extends beyond just fund management fees. It also includes trading costs, taxes, and advisory fees. An evidence-based approach discourages frequent trading, not only because market timing is futile, but also because each trade can incur commissions and, more importantly, trigger capital gains taxes. These costs act as a constant drag on performance. By adopting a buy-and-hold strategy, you minimize these frictional costs, allowing your investments to grow in a more tax-efficient manner. It's about recognizing that your gross return is a vanity figure. The only number that truly matters is your net return, after all costs have been deducted. Ultimately, focusing on costs shifts your attention from what you cannot control to what you can. You have no influence over geopolitical events or market sentiment, but you do have absolute control over the fees you are willing to pay. This is an empowering realization. By making low costs a non-negotiable criterion for every investment you make, you are actively stacking the odds in your favor. You're ensuring that the powerful engine of compounding is working primarily for you, not for a financial institution. The evidence is clear. A disciplined focus on minimizing costs is one of the most effective strategies for maximizing your long-term wealth. We now arrive at the final and for many the most difficult principle of evidence-based investing, staying the course. You can construct the most perfectly diversified, appropriately allocated and lowest cost portfolio in the world, but it will all be for nothing if you abandon it at the first sign of trouble. The data we have reviewed shows that the greatest challenge is not in creating the plan, but in sticking with it. Staying the course means trusting your strategy and remaining invested through the full spectrum of market conditions. The exhilarating highs, the boring plateaus, and the terrifying lows. This principle requires immense behavioral discipline. It is easy to stay invested when the market is climbing steadily. The real test comes when the market plummets 20 or 30%, as it inevitably will. During these periods, all of your emotional instincts will be screaming at you to sell and run for safety. The financial media will be filled with apocalyptic headlines. This is the moment of maximum danger for your portfolio. Staying the course means acknowledging the fear but refusing to act on it. It means trusting the decades of evidence that show markets recover, rather than your gut feeling that this time it's different. To help maintain this discipline, evidence-based investors rely on automation and systematic processes. This means setting up automatic monthly contributions regardless of market conditions. This practice, known as dollar-cost averaging, forces you to buy more shares when prices are low and fewer shares when prices are high, turning volatility into an advantage. It also means committing to a rebalancing schedule, maybe once a year, to bring your asset allocation back to its target. These rules-based actions remove emotion from the equation and ensure you are buying low and selling high rather than the other way around. Ultimately, staying the course is an act of profound faith. Not a blind faith in luck, but a rational faith in the evidence. It is the understanding that long-term economic growth is a powerful upward force and that the noise of short-term volatility is just that, noise. The most successful investors are not the ones who jump in and out of the market, but the ones who have the patience and fortitude to sit still and let time do the heavy lifting. This final principle is the glue that holds the entire evidence-based strategy together. Without it, the best-laid plans will crumble under the weight of human emotion. Evidence-based finance isn't about complexity, it's about effectiveness. A globally diversified portfolio can be built with just a few low-cost index funds or ETFs. For most, a simple starting point: 70% stocks for growth, 20% bonds for stability, 10% cash for emergencies and opportunity. Adjust these percentages to fit your risk tolerance and goals. The principle is to balance growth and safety, not chase perfection. This clear allocation is your first step from passive saver to disciplined investor. Simplicity, not complexity, is your edge. Building your portfolio is just the start. Automation is the secret to sticking with it. Set up automatic monthly investments. This removes emotion and ensures you buy through all market conditions. Over time, your portfolio will drift. So once a year, rebalance to your target mix. This means selling some winners, buying underperformers, and keeping your risk in check. Automation and rebalancing turn market volatility into opportunity, not anxiety. Stay systematic, not emotional. That's how you keep your plan on track. Modern apps make evidence-based investing easy. Look for low fees, broad index funds, and automation features. Choose platforms that offer global and local ETFs, like Satrix, MSCI World, or VT. Avoid high fees and hidden charges. Every saved dollar compounds. Don't get stuck searching for the perfect platform. Just start. Set up your automatic investment, pick your funds, and let time do the work. Action beats analysis paralysis every time. Every year, a new can't-miss investment grabs headlines. Meme stocks, crypto, NFTs. The hype is seductive, but history shows these manias end in painful crashes. For every early winner, thousands lose when the bubble bursts. Evidence-based investors know speculation is gambling, not investing. Real wealth comes from owning productive businesses, not chasing fads. Resist the urge to join the frenzy. Stay focused on your long-term plan. Your job isn't to predict bubbles, it's to ignore the noise, curate your information diet, avoid hype, seek data-driven sources, have faith in your evidence-based plan, not the latest craze. Success is about discipline, not drama. Let your money work quietly while you live your life. Protect your plan from distractions. Real wealth takes time and patience. The path to wealth is quiet, disciplined, and refreshingly simple. Diversify, keep costs low, stick to your plan, and tune out the noise. Evidence shows slow and steady wins. This isn't about outsmarting the market, it's about matching your strategy to how markets really work. The reward? Peace of mind and real financial freedom. By following the data and staying consistent, you build lasting prosperity. The quiet path is the most reliable one, worth every step. Throughout this whole journey, we've given you the essential knowledge you need to make smarter money decisions. Now you understand the difference between the noise of speculation and the signal of evidence. You can spot the cognitive biases that try to trip you up and recognize the core, data-backed principles that actually lead to success. But honestly, knowledge by itself isn't enough to build wealth. The last and most important step is to turn that knowledge into real, consistent action. The power of this philosophy only comes alive when you go from being a passive listener to an active participant in your own financial future. Your journey doesn't require some huge leap. It starts with small, intentional steps. It begins with opening a low-cost brokerage account. Then, you create a simple asset allocation plan that matches your goals and your comfort with risk. Next, you take the key step of setting up an automated monthly investment, even if it's just a small amount at first. That one action puts the magic of compounding and dollar-cost averaging to work for you right away. Don't wait for the perfect time to start because, honestly, the evidence shows there is no perfect time. The best time to plant a tree was 20 years ago. The second best time is today. As you start down this path, remember, you're playing the long game. There will be times when your portfolio takes a hit, and you'll question whether your steady approach is still the right one. In those moments, go back to the evidence. Remind yourself that market downturns are a normal part of the process, not a flaw, and that time in the market is your greatest ally. Have conviction in your plan. Trust the process. Your goal isn't to get the highest return in any single year, but to give yourself the best shot at meeting your financial goals over your lifetime. This is a marathon, not a sprint. Thanks so much for joining us for this deep dive into evidence-based finance. We hope you feel empowered to take control of your financial life with confidence and clarity. The principles are simple, the evidence is clear, and the tools are more accessible than ever. The rest is up to you. Make a plan, automate it, stick with it, and let the quiet, powerful magic of compounding do its thing. By doing this, you'll build a future that's not left to chance, but built on a solid foundation of evidence, discipline, and wisdom. Your smarter financial journey starts right now.